Discussing the Tesla earnings call Q2 2026. The stock's down about 15% today, the day after the call. After hours, it was down about 6%. Market's down about 2.5% also. So this is not just Tesla. We have Iran problems. But I'm going to focus on Tesla here. We're down now for the year about 21%. The market's up 8%, so I'm for about 29%. This is the worst day of the year for us on a daily basis and also as a cumulative performance basis. So unfortunately, that's what happens. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And I think this is a good example of what it feels like to run a hedge fund. We've been speaking a lot about strategy, about theory, about knowledge, business and creation, and a lot of good things. And we sometimes maybe neglect a little bit the actual purpose of this whole endeavor. The purpose of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practices. This is the purpose. So generating wealth means grow your assets, be more valuable in the future. And we're not able to do that. We're down 21% for the year. We have compounded about 15% since inception. So that's still okay. That's roughly what we wanted to do. So we set out to do that. So we are doing it. Some people might be disappointed maybe when they just reach their goals. That's not how we see it. We were always under the impression that 15% is a good return, and we still believe in that. So that's all fine, but we still have to discuss right now where we stand and where we're going in the future, because the past is really not that relevant. So where we stand right now is we have a large position in Tesla, we have a large position in NVIDIA, some other positions, but that's the main situation. And Tesla is having some trouble, and that's the purpose of this particular call. So let's start with the call itself. I think overall, I would say the situation with Tesla is you're investing a lot in capex and you don't have much to show for it. But this is roughly the situation. Now I'm going to parse that because you can't just, capex in principle is a good thing. Like capex is not a bad thing. Like people sometimes overreact when it comes to capex. The problem is not that Tesla is spending money. That's a good thing. The problem is not that we have negative free cash flow. None of these things is a problem. The problem is that we are in a business that should have overlapping situations. So meaning you have a business that grows, matures, starts generating cash, and then you have another business which then starts growing, maturing, generating cash. You're reinvesting the cash in new businesses. This is the theory. This is how actually wealth is created. This is how all of the large companies, trillion-dollar companies, created the wealth. Like you reinvest in profitable businesses. It's the best thing that can happen to an investor, right? You don't have to invest the money; they invest it for you. So all of these things are fine. The problem right now is that we have a maturing business, which is the car business, which is a good business, but it's mature in the sense that it's not growing very fast. It's growing, but not very fast. The new business, which is supposed to bring the stock to the next level, which is supposed to get the inflection point, which is supposed to create the next leap of wealth creation, is the Robotaxi business. And just for nomenclature, Robotaxi is a placeholder for transport as a service. So this could be a Model Y that is driving around unsupervised, and people unsupervised. This could be a cyber cab. This could also be a mixture of that, and then on top of that, and that's a different line of business, but it's very related, is unsupervised for customers. That is just that we're licensing a software, we're paying for a subscription for a software that then drives us around. So those two businesses are the next layer of growth for Tesla, and that is not happening right now. While in the meantime, we are spending a lot of capex for several other endeavors, in particularly Optimus, and then chip business and semi, and Robotaxi and Cybercab and expansion of the fleet and all that kind of stuff. So the way this should have worked is that we should see a line of sight of when Robotaxi business will become a valuable and material part of the business. And that is not what's happening right now. And I think that's the main reason why the stock is taking the kind of hit that it's taking. Because what you should see, or what you would hope to see, is maybe 10,000 cybercabs going around several states right now, generating maybe $1 billion in revenue, or maybe not even that much, maybe 5,000, maybe a few $100 million in revenue, but something that shows you that this is actually a real business, that there's demand for it, and that now it can be scaled from small to large. That is not happening right now. This is still a proof of concept. This is still some sort of science project, like some of the shorts are saying, and they're not wrong about it. Right now, this feels like a science project, and that's why the stock is taking a hit, while at the same time, we're doing a lot of capex. Now, I don't think that the capex is a problem. In fact, I think the capex is necessary to support the stock. You have to have investment. You can't grow a business if you don't invest. So that's not a problem. And you can say, look, some of the businesses, solar business, Megapod, I don't know, whatever they came up on the earnings call of new stuff. These things are debatable. I don't even want to, I don't want to be too harsh on them when it comes to these things, because you want to have a lot of options here. And Tesla is creating a lot of options. So these are all fine. I think they have $43 billion in cash on the balance sheet. That is fine too, meaning you can use, maybe half of that to expand into new businesses. But what you want to see, again, you want to see the Robotaxi business starting to scale at a point where it's becoming, at least there's a line of sight of how it can become material. And that is not what we're seeing right now. That is why the stock is down so much, in my opinion. So that's the situation. I think there's some details that I'm not going to discuss too much about margins. We're also going to have a call with IR, so maybe we can do a follow-up call on that. I am not too concerned about the margins either. My partner is concerned that they're giving away the car for free to scale up the software business. I don't think that's the case. And by the way, even if that was the case, I'm not too crazy. I mean, I'm not too nervous about that. Look, as long as these cars drive around in the millions, this is a good thing for Tesla. This is a good thing for Tesla in many ways. You can learn, you can expand, you can sell software, you can do a lot of things that you can't do if people don't buy the car. There's competition in the market, so that is a problem. I think what I want to talk about very briefly is the energy business. I think the energy business is another source of concern here, because we had a sharp decline in revenue per gigawatt hour from about 290 to 230,000. I'm not sure if the numbers are right, but 290, 230. I don't know if it's thousands. I'll have to do the math. But anyway, there's a decline in revenue per watt, let's say, a decline. So meaning you're growing the wattage, you're growing the business as far as volume is concerned, but you're growing a lot less your revenue because your revenue per watt is declining. And that is a concern. I think that is real. This is not a one-off or anything like that. This is China competition. So puts a bit of a damp on the energy business, right? It's a great business. I think we all like the business. In the age of AI and energy shortage, that is a huge business actually to be in. But unfortunately, unlike many other energy businesses, whether it's GE Vernova or whether it's Plug Power or I don't know, all these companies that provide energy, Caterpillar, like all these gas turbine type companies and all it looks like there's a shortage everywhere, but in the products that Tesla is providing, and that could be. I mean, that's just the reality. It's because the whole of China is just copying Tesla. So if they do X, China's doing X. If they do Y, China's doing Y. Versus nobody's competing with, you know, Howmet Aerospace or GE Vernova or whatever. I'm exaggerating a bit, but this is kind of the way we see it. So that's a concern. Now, I don't think the energy business has huge bearing on the stock, but still, I mean, it's a nice sort of complementary business now. It's growing, and maybe it's just kind of in the coal mine that you're in a competitive business here, like the car business, and if your ASPs decline dramatically, you're going to have a problem. Now, here is some of the good news, or why would you even hold on to this stock, right? This is the big decision that we have to make as investors. What is actually holding, what is good here? Well, FSD is a good, is good news on every front. It's working, the product's great, demand is very strong. The people are buying FSD now because they want FSD. They don't even want the car necessarily, they want FSD. It's 55% attach rate, so that, from about 10%. So that's really a phenomenal news. And I think that's probably a little bit underrated right now in the market. We really have a high attach rate for FSD. And this is not just going to be the case in the US, this is going to be the case everywhere else. So that's good news. I think that's good news, and I think we should cherish that. Demand is very strong. Demand is driven by FSD. Demand is driven also by the oil price. We shouldn't underestimate that. We've been actually living in a sort of flat volume growth regime for years now, and we are now in a growth regime. Now, the production of this quarter was only 50,000, in Q2, meaning they are drawing a lot of inventory, and that could be a question mark. But the CFO said we have very strong. We're going out very strong into Q3, and therefore there is expectation of high volume. I think, given what's going on in Iran, given the oil price, this is also good news for Tesla. So where do we stand now? We have to weigh the pros and the cons. I think Tesla is kind of a non-stock right now. You can't buy it, you can't sell, you can't short it. You cannot short the stock. The stock can double in your face in split second if they get unsupervised FSD somewhere, and China or something, or Europe, or the US. Supervised FSD in China, and then Europe, unsupervised in the US, and demand goes through the roof. You have maybe a price increase of subscription. Tesla has a lead on FSD. This is the reality. Like, you're shorting a stock that has solved autonomous driving in a general form. I think the problem with FSD is regulatory, political. It's not even regulatory in the sense that this is a regulation that actually makes sense. I think the regulation should be that we should have as many robots as possible and as little human driving as possible. But the political backlash is understandable. And trial lawyers, for example, they will lose business here because if there's no accidents, how are they going to make money? So that's, I think, in a big picture situation, what's going on. Again, can't buy it, you can't sell it. It's a non-situation. It's very similar to SpaceX. I think SpaceX is like Elon Musk has talked himself into this type of extreme high valuation, high expectation situation where he is able to deliver. He is delivering. This is not a situation where they're not delivering, but they can't possibly deliver at the time scale that is necessary to justify the stock. But then, of course, at some point they will, and then the stock will readjust, will have the inflection point. That's the way we see it. I don't want to jump the gun now in terms of what we're doing, but I guess one thing I can disclose here is that we're definitely, for the first time in a long time, considering selling the stock, because it's not like we're afraid of losing money here, but there's a time in the life of an investment when you have to move on because of your own sake, because you need to actually maybe do other things. You need to recalibrate yourself. You need to do something else. But then there's a lot of reasons to hang on to. By the way, what Ashok said, and I just want to throw this in, I mean, for regular listeners, you will definitely agree with me that our focus has been on robotics, particularly humanoid robots here for the last 6 to 12 months. We've, starting with academic conferences like CVPR, we discuss papers, we go to seminars. I mean, we are definitely in the loop when it comes to robotics, in particular humanoid robots. And what Ashok said on the call is very encouraging. They're training the robot based on FSD, the process of FSD. So they're using humans and cameras to show the robot what to do. They're using video to augment that. So then they have the Optimus factory for mid-training. Basically, they're doing, foundation model training at scale through humans, like FSD style. What that means is that you're using human behavioral cloning, and you're using videos from YouTube. So you just have, a large internet scale video database of humans doing tasks, and then the mid training happens in the factory, in the Optimus factory, where you fine tune the skills that are necessary, and then you have reinforcement learning and the final stretch of training where you let's say you train against benchmarks or some sort of eval that you care about. So that is a pipeline, a video humanoid robot training pipeline that we subscribe to, and it's great to hear that. It's great to be on. I think we're very much in sync with the company, and that's great. And I think we shouldn't underestimate the potential of something like Optimus. It's just that right now, of course, it's just not that relevant right now, and it's very difficult for an investor to put their capital in something that is out there at some point, but not right now. Like we need some. I guess my point is, and I'm sorry, maybe I come across a bit babbling because it's really hard for us. It's hard. I just came off a 2-hour conference call about this, and it's just very difficult to make a fundamental conclusion that, like, this is not we can't just say, okay, this is black and this is white, this is X and this is Y, this is how we're going to do it. That's not how this is work. This is not how this works. Unfortunately, it doesn't work like that. But there's a lot of interesting reasons to be long and interesting reasons not to be long. So I guess, where am I going to leave you here? We have to make a decision about this investment. I don't think this is a situation where we want to trim the investment or anything like that. Maybe that's what we're going to do. But this, to me, feels like either you're in or you're out. The question of alternatives, like back to the purpose of this podcast, how does it feel to run a hedge fund? Well, you have opportunity costs, right? What's your cost of capital? What else could you do with the money? Let's say you could buy real estate. You could buy gold. You could buy Bitcoin. You could buy Micron. You could buy Google. You could buy Apple. And you name your stock or your asset. For $2 million, you put another $2 million in debt on top of it. In a place like Switzerland, you can buy a very nice place. And then you have some rental income, or you even don't have rental income. You just make net present value appreciation. So there are opportunities to make money outside of this investment. And this investment has been disappointing in the last 5 years. It keeps being disappointing, and we have to reconsider. There's good reasons to be invested because the company has been delivering on a lot of fronts, on a lot of the vectors that they promised us. They are expanding. It's just that they're not doing it at the pace that the stock valuation requires, particularly as in contrast with opportunity costs, with other opportunities. Elon Musk said that we're not necessarily fully invested in capital efficiency because speed is important. There's a trade-off between speed and capital efficiency. In other words, we're going to waste some capital here, but we need to be fast. And the reason we need to be fast is because competition is out there. And that's scary for the market. I think that's part of the reason also why the stock is down. But like, you can turn this around also. Yeah, I mean, do I want my company to be super capital efficient, like a Warren Buffett company, or do I want them to be fast and iterate and break things and make mistakes? Yes. So you see how this is just a very difficult situation to gauge. But I would say, when everything is said and done, this is still a very good company. This is a fantastic opportunity. And we're just tired. We're exhausted. And we have to reconsider ourselves. This is about us. This is more about us than the company. So we have to kind of introspect, like, what is it we want to do as investors, as people? Like, what's my role in this? How do I want to spend my time? Do I want to keep analyzing the situation? Or do I want to do other things? And we just need some feedback, some positive feedback. We're down 21% for the year. That's not positive feedback. So if you're getting tired and exhausted of the situation, and the metrics in your business are in the red, you have to reconsider. So again, I think Tesla as a stock is fine. You can own it, particularly at 320 a share. It's not that bad. But you need to consider your own psychological balance, your purpose in life, or whatever you want to call it. And that's where we are right now. This is a very tough situation, but that's where we are. And I think we're going to hang on to the positives. There's a lot of work that has been, all the work we've done in robotics. It should bear fruit, right? I mean, just in principle, it should bear fruit. It's not bearing fruit right now, but in principle, when you do this much work on a field that is this much promise, shouldn't you also be rewarded for it? Well, that's not how the market works. The market doesn't really care what you've done, but you, for yourself, you have to kind of be very, very crystal clear about what is it you want to do, and which type of investment do you want to be exposed to? What pushes your buttons? An earnings call like yesterday, a situation like now is not what pushes my buttons. I can tell you that. I was very excited about the delivery numbers in early July. I was frustrated about the stock selling off. Yesterday, when I saw the shareholder deck, I was disappointed. The stock was down about 4% after hours. I thought to myself, yeah, okay. We should have been up 10, 20%. Now we're not. But to be down 15%, that's a tough one. That's a gut punch. And we're going to have to recover from that.